Good afternoon, ladies and gentlemen. Welcome back to 24th of June weekly market review. So fast, we are into the final week of June already, coming into the half year mark. And today I have with me Mr. Gerald Wong as usual. How are you, Gerald?
I'm good. Like you mentioned, we are now getting to the last week of June. For those who have kids, probably aware that the school holidays are over as well. So, Sadi, I heard you've been quite busy over the past weekend, managing some of this back to school stuff.
Yes, back to school stuff, have to pack the bags again, prepare their uniform and stuff. Oh yeah, but then I get a bit more of a freedom back this week. Yeah. And last week we saw in the market that the S&P 500 and Nasdaq sort of a pullback quite a bit on the later part of the week on Thursday and Friday. But then Dow Jones have the best performance since May. So a bit of an itinerary over there also, but I think that's because the tech stocks is getting too far ahead in valuation, and it seems to be broadening out to the rest of the stock market. Hence, the Dow Jones index was able to register a good performance for the month of June. So will you be going through some of the developments for us today, Gerald?
Yes, so a number of things that we'll go through both in terms of the economic outlook as well as what the implication is for the stocks. And then going to two stocks in Singapore, we saw fairly large movements in the past week. Okay, as usual, today's sharing is for information purposes only and should not be taken to be financial advice. We have a Ask SIAS session on 17th of July. This is exclusive for members of SIAS. And if you are interested to take part, you can scan this QR code to register for the Ask SIAS session. If you find our weekly market review helpful, do leave us a review on Google. And if you are wondering how you can join SIAS as a member, you can scan this QR code or go to sias.org.sg/membership. The membership will cost $12 per year or just $1 per month. Okay, so what we saw in the past week, like Sunny mentioned, this was the overall performance for the whole of the last week. The S&P 500 still managed to have a gain for the whole week of about 0.6%. But this is after the slight dip at the later part of the week, given that at one point in time, the S&P 500 was above the 5,500 levels. What we can see from this is that the Dow Jones did better than the Nasdaq in the past week. The Dow Jones was up by 1.4%, while the Nasdaq was flat for the past week. Okay, so like Sunny mentioned, this probably reflects that investors are taking some profit from the good performing tech stocks and actually transiting towards maybe some of the value stocks that they might see in the Dow Jones index. Closer to home, the STI was quite flat as well at 3306, up 0.2% for the week. But even within the performance of the STI, we saw quite a big divergence in terms of single stock performance. So I'll go through some of the stocks that did better as well as some of the stocks that didn't do as well last week. Okay, the macro news that came out last week was really the retail sales data in the US. The number was actually weaker than what the investors were expecting. And as we can see from this chart, over the past 2 months, the retail sales on a month-on-month basis hasn't been particularly strong. So that might partly reflect that the US consumer spending is tapering slightly. And with that, it might once again give the Fed more confidence about cutting interest rates. So this is what we see as well for the bond yields, continued decline such that we are now back to the lows sometime in March. So effectively, what this effectively tells you is that investors are expecting that the Fed might have more confidence around cutting interest rates. Okay, in terms of the top performers for the STI in the past week, we saw Jardine Cycle and Carriage up by 6.1%. We saw Singtel with a 3.5% gain, Venture 2.2%, Wilmar 2%, and CapitaLand Invest. Singtel has effectively performed quite well in the past few weeks, and I'll go through what might be some of the reasons behind this outperformance. Okay, in terms of the worst performers, Seatrium was down by 9%, so a standout here. I'll go through later as well what could be a reason behind Seatrium's share price decline. But apart from that, we saw Thai Bev down by 2%, UL likewise mirroring quite a number of weak performance amongst the developers, down by 2%, SETS 1.7%, and CapitaLand Ascendas REIT 1.6%. So as we can see, in terms of the STI best and worst performers, a number of stocks that stand out in terms of the performance, one of which is Singtel, one of which is Seatrium, and I would like to just go through in a bit more detail what are some of the key developments affecting the share price. Okay, we start with Singtel. So as you can see from this chart, effectively since the start of May, it has started its ascent from about $2.35 to now about $2.64 as of Friday's close. So it is actually close to the 52-week high of about $2.68 that was achieved just in August last year. Okay, so you might be wondering what is driving this share price outperformance. What was announced last week is that a KKR-led consortium of KKR and Singtel will invest 1.75 billion in STT-GDC. What this STT-GDC is that it's one of the world's fastest growing data center providers with more than 95 data centers across 11 geographies. So this transaction actually marks the largest digital infrastructure investment in Southeast Asia year to date. Okay, so a very significant transaction. And if you're wondering how this will fit into Singtel's overall roadmap, we can go back to its recent strategic review that was announced in May that actually also led to the share price rally that we saw. Okay, so this is actually the Singtel 28 or ST28 strategy that was announced. Previously, Singtel embarked on this strategic reset where they sharpened the business focus and started on the capital recycling program. But this Singtel 28 growth strategy that was announced effectively aimed to further lift the business performance and improve on the capital management. Okay, so effectively, we see that these are the two key pillars. Once again, lifting the business performance, smart capital management, and with that, it is aimed to realize sustained value and thereby driving dividends as well as growth over the next few years. Okay, so part of it entails improving the performance of the core businesses, including in Singapore, in Australia through Optus, as well as the regional associates. So those are seen to be something that is core, and Singtel aims to further improve the performance here. But going back to the acquisition that was announced, effectively, this would fit into some of its growth drivers, including the digital infra co, which is called Nexera. Okay, so Nexera is effectively Singtel's data center business. They effectively aim to grow this business. One of the key initiatives here is to deliver one of the key data centers in Singapore by 2026. But they also aim to increase the capacity of Nexera's data centers. Okay, so this will actually fit into Singtel's strategy to be growing this part of the business. At the same time, there are various services that are provided as part of this business, including what they call GPU as a service. So this will effectively leverage on Nexera's data center capabilities. Okay, so you might be wondering how will this affect shareholders of Singtel? Effectively, what we have seen Singtel coming up with is a new dividend policy. This will involve a core dividend between 70 to 90% of the underlying net profit after tax. And if the underlying performance of the business improve, then with that, if the net profit grows, then ideally the core dividend should grow as well. But what Singtel has also announced is this value realization dividend. 3 to 6 cents per share annually, and this will effectively be funded from the excess capital as well as any capital that comes through from capital recycling initiatives. Okay. We have already seen that in terms of the FY24 dividend payout. We see here that over the past 3 years, Singtel's dividends has started to recover. And on top of the dividends that were announced that come through from the core profit, we also see the value realization dividend in FY24 of 3.8 cents. So that will bring the total dividend to 15 cents, implying a yield of about 6.3%. Okay, so that is effectively Singtel's latest developments and what is driving the strong performance over the past month. Okay, next we have Seatrium, where we saw a bit of correction in the past week. Effectively, if you look at Singtel's Seatrium's share price, it has been very volatile. We saw that following the announcement of the exclusion from the MSCI index, the share price came off. Okay, then thereafter it won a very big order, which led to the bounce in the share price. But more recently, we have started to see Seatrium's share price coming down once again. Okay, so the news for Seatrium is that the MES and CAD are conducting a joint investigation into offences potentially committed by Seatrium and or its officers in connection with Operation Car Wash. Okay, so if you need a recap around Operation Car Wash, this is really the Brazilian anti-corruption drive where we saw Seatrium being implicated. So the authorities have requested for further information from the company, and with that, we have seen a sell-off in Seatrium shares in the past week. Okay, so in terms of Seatrium's latest development, we saw earlier that Singtel had announced a strategic plan for the next few years. Likewise, for Seatrium, if you were to look at the longer term, they have also announced such a longer term plan where they aim to bring EBITDA to above 1 billion and return on equity to above 8% by 2028. Okay, so this will represent a 4 times uplift to the EBITDA as well as a turnaround in the ROE versus what they were able to achieve in FY23. Okay, so part of this expected growth in EBITDA is expected to come through from an improvement in their revenue as they try to win more orders, especially those within the renewable segment. That was actually intended to be able to boost Seatrium's revenue and hence its EBITDA. Okay, so with the expected growth in revenue, if they continue to deliver well, Seatrium had expected that the EBITDA will be able to grow from 200 million to 1 billion by 2028, and thereby turning around the ROE to more than 8% by 2028. Okay, some of this will also come through from synergies and cost savings following the combination with Keppel Offshore and Marine. So 300 million of annualized synergies and cost savings and 200 million of procurement savings, which will also help to drive the EBITDA uplift apart from the improvement in revenue. Okay, so this is the longer term roadmap that Seatrium has actually shared with investors. In the meantime, the share price has taken a hit because of the concerns around how it may be impacted from the latest news flow. So those are the various things that we need to continue to keep a lookout for as they will continue to impact Seatrium's share price performance. Okay, so in terms of what to look out for in the week ahead, we are coming close to the end of the month. So as usual, we have the Singapore Savings Bond application closing date. Tomorrow, SIAS is organizing a corporate connect with Takra as well. So if you are interested to learn more about the company, do join this corporate connect. And on the macro front, just one key data point that I'll be keeping a lookout for, which is the US personal consumption expenditure data, which will continue to give us an indication around inflation trends in the US. Okay, so with that, I'll hand over to Sunny, who will share with us the technical analysis.
Hey, let me share my screen first. Okay, thanks Gerald for that insightful sharing on some of the big movers on the STI index last week. So let's take an overview look on the STI chart and the performance right now. So last week we have a slightly shorter trading week because Monday was a holiday. And we can see that once we started on the 18th of June, the Tuesday, last week we projected that probably STI will be coming down towards this gray shaded area where it will try to find some support to try and stabilize the decline that we observed since the beginning of June. So we identified the support area around the 50 days moving average, okay, which is the blue line that you see here, which is now currently reading at 3,287 points. Last Wednesday, we reached a low of 3,288 points. And the next support level would be the 100 days moving average in amber over here, and that's around the 3,252 points. So the average around these two levels between the 50 days and the 100 days moving average would be somewhere around the 3,275 points level to look out for. So I'll be looking out for opportunities to get in on the STI once it breached below the 50 days moving average. And using the indicators as a guidance, I also see that the MACD indicator is still having a negative reading. Hence, there is still negative momentum in the STI index right now. But this negative momentum seems to be slightly subsiding in the previous week, in the last 4 trading session. So that means that we could be stabilizing around those areas, those key support areas that we mentioned earlier between 50 to 100 days moving average. On the RSI, we also see that the RSI has been trending downwards since the beginning of June. And you can see that the latest reading now at 47 is still below the 50-point neutral mark. So that means that momentum in the STI index is still weak, but not really that bad. Hence, it is going into a phase of stabilization or consolidation. We also have not reached any point close to the 30-point oversold mark yet. So a quick rebound in the short term is highly unlikely. So for now, I believe if the STI pull back further, it will be a chance for accumulation, not expecting a quick rebound now on the STI index, maybe at least until it reaches the 3,250 point level, which is the 100 days moving average, often used as a pivot level. Next, we move to the US indices. So we mentioned earlier, Gerald also said that we see a sort of a good performance, a very good performance from the Dow Jones Index compared to the other two indices. So you can see that the Dow Jones Index for the last 4 trading session has been sort of a rebounding very high up. And once on Friday it hits the upper bound of the Bollinger Band, it starts to slow down a little. So it is also expected. You can also see that on the volume chart, there is also a big negative red candle, which means a lot of people are taking profits over this resistance level, which is the upper bound of the Bollinger Band, now at 39,249 points. So the key support level for the Dow Jones Index will still be this amber line that you see here. And since the April period, it has been providing very good support for the Dow Jones Index. And once it tested this level, which the latest one was on 14th of June, Friday, market saw a rebound upwards. So where is the Dow Jones Index likely to head going forward? We can see that there's now a positive reading on the MACD indicator right now, meaning that there's positive momentum on the Dow Jones Index. However, if I try to zoom in on the MACD line and the signal line trajectory, it seems that the angle of attack, I would call it the crossover, wasn't that significant. So any upsides would likely be limited. And the next resistance level for the Dow Jones Index will still be around the 39,800 or 900 points level, which is one of the highs that we observed in the March period as well as in the May period. On the RSI indicator, we see a bit of a healthy reading, the latest reading at 56, 6 points above the 50-point neutral mark. Hence, there's still some positive momentum now in the Dow Jones Index. this is coinciding or finding confluence with what the MACD is saying. So probably it will still be able to trend slightly upwards on the upper bound of the Bollinger Band. Okay, so key support level, 100 days moving average, 38,459 points right now. Key resistance level, 39,889 points, which is close to the high of what we observed in the April and the May period. Next, let's move to the broader index, the S&P 500. So while Dow Jones Index had quite a good performance last week, you can see the S&P 500 seems to be muted, and on the last two trading sessions on Thursday and Friday, it seems to be pulling back a little. So we have also touched a new all-time high, intraday high for the S&P 500. Okay, somewhere on the Tuesday period, I believe. Yes, on the Tuesday period, we touched a high of 5,505 points. Okay, on the Thursday period, sorry. So that means we have a new all-time high in sight, which is now testing the upper bound of the Bollinger Band already for quite a bit of time. And looking at the indicators, the MACD is showing it still has a positive reading, but it's showing us in the last two trading sessions that the uptrend momentum that we observed since let's say the beginning of June is starting to subside right now going into the end of June. On the RSI, we have also hit above the 70-point mark, which is the overbought mark right now. Okay, and the latest reading at 71.3 is still above that level. Hence, there might be a technical correction towards the S&P 500 because the indicators have also said that the index is a bit of an overstretched or overextended right now. And key support levels that we are looking at, of course, the 100 days moving average, we saw that somewhere near the 18th of April, there is a huge bounce over there. And the 50 days moving average does not seem to really be of a irrelevance since the beginning of the year, because S&P 500 has been trending very strongly using the 20 days moving average as a support. So for me, I believe the S&P 500, if it pulls back to the 20 days moving average around the 5,360 points level, that could possibly be a point that I will start to accumulate on the S&P 500 index again. And I will take reference from the 23rd May high, that is around the 5,341 points level. So around the 5,350 level, that is where I'm looking at a possible rebound for the S&P 500 index. Okay, lastly, let's go to the tech-heavy Nasdaq Composite Index, which finished flat last week and was the worst performance among the three major US indices. We saw a big decline of 140 points last Thursday on the Nasdaq Composite Index, and on Friday we dropped another 32 points. So pullback on the last two trading sessions as well. Indicator-wise, you also see that the MACD indicator showing that the past three trading sessions in the Nasdaq Composite Index shows that the positive momentum that we observe in the index right now is subsiding, and we also observe a candlestick of a doji formation, meaning a possible change in direction on Tuesday, 18th of June. The RSI is now also have been stretching above the 70-point mark, which is the overbought mark level on the RSI indicator, and it is still now slightly above the 70-point mark. So I believe technical correction is also likely due for the Nasdaq Composite Index to pull back towards the 20 days moving average, at least now at 17,305 points. Other key support levels that I'll be looking at, of course, will be the 100 days moving average similar to the S&P 500. So that could be the level at 16,268 points. That would be a key level if a major pullback happens. But for now, I am still sort of confident that the tech rally is not sort of ending anytime soon. It will likely continue to push ahead, and that means that I would be observing RSI closer to the 50-point neutral mark, because when you see in the earlier part of the year, once the S&P, the Nasdaq Composite Index pull back, the RSI pull back to near the 50-point level, which is the neutral mark, it starts to have a bit of a support and rebound back upwards. Okay, so the first level of support for Nasdaq Composite Index will be the 20 days moving average at 17,300, with a major pullback support at around the 16,268 points. So this is my roundup of the index this week. Anything to add, Gerald?
So we are coming to the end of June. I think by the next weekly market review, we'll be into the second half of the year. And I guess investors will be looking out for the Fed potential rate cut into the second half of this year. That's something that we are looking out very closely for as well. So if you want to stay updated around the latest macro developments, how this will impact your stock investments, do continue to keep track of our weekly market review.
Yes, so I think that is the time that we have for today. So as usual, we'd like to thank everyone for joining us today on our weekly market review. And we'll see you again next week on Monday in the next session with Gerald and myself. Okay, have a good trading week, trade safe and stay safe and goodbye.
Thank you.